Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Wednesday. It's April 27th, and the market yesterday, oh boy, the last 2 days have been something. I think it's a combination of earnings, volatility, and the geopolitical events that are taking place, and most of all, the Fed. But let's talk a little bit about what's going on pre-open. The market's going to open up in about an hour and 22 minutes. The market's pretty steady right now. The Dow's up about 200 points. The Nasdaq is up about 22 points. But again, we're going to have to see how the market trades during market hours because overnight volatility is very different from intraday volatility. Now, to give you the big spotlight of the day, we're going to have earnings on Meta. And they'll be released after the close today. This is the number that analysts are expecting, $2.50 per share, which would be down 22% from a year ago on revenue of $28.2 billion. So they're supposedly made about a quarter less on earnings per share, but they made a positive close to 20% on their year-to-year revenue. Other companies that are going to be reporting, and again, just there's a lot of them. There's a lot of companies reporting today, several. We're deep in earnings, which is why the volatility is so high. Markets are all over the place. But just to give you a little preview, you got Align Technology. This is the expectation. And you want to keep an eye on the expectation because the market volatility tracks from the number being different than the estimate or forward-looking statements. But Align is a big one that's coming out today. Amgen's coming out today, 413. ADP's coming out today. Boeing is coming out today. Look at that, negative 15 cents. You've got Checkpoint Software. You've got CME Group, almost $2. You've got Credit Suisse. That's going to be a big one. Discovery for the financial services. Equinox, that's a big one. Garmin's a big one. General Dynamics, one of my favorites right there. Healthcare, Harley Davidson. So all the big names. Kraft is coming out today. And it's getting fairly mixed. It's no longer just financials. We're pretty mixed right now. You've got Qualcomm, Pinterest. You've got Old Dominion Freight Line, O'Reilly. Keep an eye on this stock. It's looking really, really well. But the point is, you've got a lot of earnings. So it's hard to make heads or tails out of the current market with what we're seeing right now. But what I do know is this. I know that the market has been choppy ever since the beginning of this year. And right now, the Nasdaq looks like it's approaching the RSI 30 level. And whenever we get to this level, not always, but typically when we get to these levels, we get a nice rally. So if we can get a nice rally back to the 200-day moving average, that would go a long way. But the Nasdaq right now is at the lowest level we've seen in a very, very long time. Matter of fact, I think the price of this low right here that we hit, we haven't had a low at that level since, let's see here. Look at that. All the way till beginning of 2021. So it looks like we're close to the base. I'm not expecting too much of a breakdown. My ultimate low level is right here, the right around the October level, which is at 275, but I don't know if we're going to get there or not. Right now, I'm more bullish because the RSI is overdone. Now, looking at the SPY, looking at the technical levels on the SPY, looks like we're almost at that level, and again, RSI is there as well. And we are, let me just give you a broader perspective. This choppiness right here, this choppiness, to me, because we're kind of moving up and down as opposed to just a straight linear line down, kind of like we're not doing the opposite of this uptrend. We're kind of getting choppy. This is telling me the consolidation that we're seeing in the high volatility will revert itself and the market will go higher. But till we're at the 200-day moving average, we are in bear territory. A few positives. The bond market's moving higher, which is telling us that it's telling the Fed we can't handle this anymore, or it's expecting the Fed to change short-term policy because the market's not in a good position right now. But the bottom line is the long bond moving higher is telling us that interest rates in the short term are not increasing right now. A few other things. Volatility, we're at 31, but again, I mean, we dropped quite a bit and we're at the lowest level. I would have expected volatility to be somewhere near the COVID levels, but we're just not seeing it right now. Let me show you something quickly here. Yeah, here we are. That's a better chart. So you could see here, this is a much better chart. So you could see here, this is right here. No, Let me see if I can find the COVID levels. Let's see here. I got to go back a little further. Here we go. That's the COVID right here. That's the COVID scare. So when you look at it comparatively, right, on a weekly basis, we're nowhere there. We're like at 33. So I'm not really seeing a huge, huge, massive volatility spike. I'm thinking kind of something like this, and then it reverts back down. Ultimately, I'm expecting volatility to revert lower, not higher. So we got to be very, very cautious right now. But the bottom line is I'm not seeing the market structure being threatened in any way. Put to call ratio is still very much favoring the turnaround to the put side. So this is a really stretched out market right now. If we were at 70 right now and the market was, and the S&P was at these levels, I would be very, very nervous. But it looks like the put to call ratio is telling us we're stretched out. Volatility is telling us we're stretched out. The bond market is now reverting higher. It doesn't seem like we've got that much more to go. We've got Fed data today. We've got international trades in goods and services, but honestly, that's not what's driving the market. The GDP is what's going to be driving the market tomorrow. That's going to be a huge, huge report. Consumer sentiment, consumer discretionary is responsible for about 70% of the GDP. So the fact that consumer confidence was not too bad tells me that the GDP will be okay. If the GDP is not okay, then the Fed has some leeway. Then the Fed can say, hey, we have to slow down on raising rates because our economy can't handle it. If the number's really, 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 really solid, then they could say, well, we told you so, and it's time to get more aggressive. Just to show you, the consensus is all over the place, which means they have absolutely no clue what they're looking at right now. But the market is baking in 1.1%. So that's the number we want to look at. Just to show you, last time we were at 6.9%. So this number is quite lower, and it's a good case. If the number's even lower than that, it's a good case for the Fed to say, hey, we're going to slow down. This half a basis point may be too much, and that would cause the bond market to rally short term. In terms of global economy, let's talk a little bit about global economy. Global shares were mixed Wednesday. U.S. futures were higher and oil prices rose, but for a very good reason. The focus is on energy markets. Gas prices surged as much as 24% in Europe. And the euro weakened after Russia said, and this is a big one, it would cut off supplies to Poland and Bulgaria, which means now we have another shortage of energies because somehow Poland and Bulgaria have to get their energies. And obviously Russia's doing this as a retaliation because there are several because Poland and Bulgaria are helping Ukraine, but that's obvious. In Shanghai, they gained 2.5%, which is good. The smaller Shenzhen benchmark jumped 4%. And they're basically talking about blow the economy from pandemic lockdowns, dozens of cities resulting in disruptions to trade and manufacturing. Hopefully, they will counter those sooner than later. The Bank of Japan sent a clear message. They're going to keep their rates very, very low for the foreseeable future. War in Ukraine, the big factor. Inflated prices for many commodities and goods are still going to go higher. I mean, unless this war ends, we're not going to see a reprieve. Earnings for industrial retail companies are a key focus for the rest of the week. It's pretty broad right now. Airline maker Boeing reports today, industrial, Caterpillar tomorrow, as I mentioned, and McDonald's and Amazon. Oh boy. With the Federal Reserve set to aggressively hike rates, it steps up its fight against inflation. Traders are less willing to pay Microsoft, Facebook, and tech giants. Several big tech companies are due to report earnings this week, including Meta and Apple on Thursday. So we got to be very, very cautious right now. We got to be strategic. Keep your eye on international trades in goods and services. But right now, volatility is running wild. I'm expecting volatility to start coming off over the next few days and start coming back down to the base. That's number one. I'm expecting prices to start reverting higher. I don't think this downtrend is going to remain. Also, we're seeing some divergence here. Just to give you an idea, lows, highs, those usually don't last and markets revert. So I'm actually a little more bullish than usual. Now, let's talk about sectors, right? We've got to talk about sectors. So today is Wednesday, and what do I always do Wednesday? I always give you my top stocks and my bottom stocks. So my top stock right now is Marathon Petroleum. I like it, and I think we're going to rally right now. This is a perfect spot for it right here. MPC right there. And to the downside, let me show you some stocks that I'm looking to the downside. There we go. GLW, Corning. I mean, it jumped up, but I think it's going to come right back down. Let me just put it up on this chart, GLW. Whenever you see a strong downtrend like that, typically we revert back into that downtrend. So, I mean, look at this. Anytime you see gaps like that, you just fade them. So I would be fading Corning right now to the downside. I think it's going to come right back down, maybe next couple of days. And remember, low hanging fruits. And to the upside, I like MRO right now. Looks like energies are setting themselves up for a nice juicy pullback to the upside. We're right at the 50-day moving average right here. And I think we're going to go higher on the commodity stocks and basic materials and energies because of what's going on with Russia and Ukraine. Low volatility. You need to right now lower your volatility. So what you need to do is you need to not have as much exposure in the market. And the reason is let me show you something. This is actually really important, something I want you to pay attention to. If you look at volatility, this is just all this shows is volatility. We went from 697 points a day on the Dow all the way down to 464, and now we're moving higher. If this volatility spikes, markets are probably going to go down. If we revert right here back down, that means volatility will go lower. But the fact is, volatility is still around 560 to 700, roughly between 694 and 500 points a day on the Dow. So you got to be very, very cautious. I am a little more bullish than most because I have faith in my RSI studies, and I think we're going to go higher from this point on. But the next few days are going to be very volatile because of earnings. Now, I've got something important for you guys. One of the most influential governing bodies just made a move that sent shockwaves through the markets. Many traders have no clue, but that set off a domino effect. And according to Chuck Hughes, who's a 10-time trading champion, according to Chuck's research, a handful of stocks are set to take off as a direct result of this. But it's probably not the stocks that you're thinking of right now. It's about a whole new market cycle, new stocks, new trends. I've been talking about this for a while now. So Chuck and I were pulling back the curtain on what he believes to be the most convincing market signal of his lifetime. Folks, this is big, of his lifetime. Click the link below and learn about takeoff. And watch our presentation now. Tomorrow, top ETF, top option pick. Follow the link below. You don't want to miss what Chuck has to say to you. This is big. This is the biggest market signal of his lifetime. He's convinced, all right? Don't miss out. And if you're watching on YouTube, like us, subscribe to our channel, and if you can't find the link, go to the YouTube Wealth Press channel. It should be under the descriptor, and have a great day. Bye, guys.